This video is about the coronavirus, Wall Street's reactions to it, and some important trading lessons that can be drawn from it. On January 28, 2020, news of the coronavirus first surfaced from the city of Wuhan. For some reason, Wall Street ignored the situation, with the markets making new all-time highs at the time. February 24th, just a week later, the markets dropped 4,000 points within a week on fears of the coronavirus becoming a global pandemic. This was a never-seen-before market event that would have great implications to the financial markets and the global economy. A flash crash type of event that my mentor, Joe DiNapoli, have been warning about for years in his lectures around the world. It finally happened, and if you are an active trader or investor involved with the markets, we want you to hear about this. That's why we have prepared this webinar to warn traders and investors about the real reasons behind this massive market sell-off. They will teach you a great deal about market mechanics and how markets work. We will also teach you the practical application of advanced Fibonacci trading techniques to investment markets.
I'm Joe DiNapoli. This webinar is about the market's reaction to the coronavirus. I'm going to give you my slant on it from my point of view. That's the point of view of a trader, somebody that trades hundreds of E-mini contracts and NASDAQ contracts weekly. And I've been at this since 1982 when the S&P futures contract was started. Before that, I traded the value line contract. I traded the break in October 1987 and also during the 9/11 tragedy. This is a cash chart of the Dow Jones Industrial Average. Clearly shows an XOP massive expansion resistance level at approximately 28,200. Since I developed the DiNapoli expansion method roughly 35 years ago, I have never, ever in my trading career seen such massive overhead resistance. This is truly a special event. The crash that we had in the market in 2008 was completely different than the crash that we saw the last few days in the Dow Jones Industrial Average. In 2008, there were throwback rallies, significant throwback rallies, and those were tradable throwback rallies that simply didn't exist in the last week of the market action. And so why? Well, the answer is that in March of 2009, the market was taken over by Skynet. Computer algorithms, high-frequency trading have changed the character of the market fundamentally. And in order for you to understand the 4,000-point drop that we had in 1 week in the Dow Jones Industrial Average, you have to understand the impact that high-frequency and algorithmic trading have had on our markets. So coming from a technical point of view, I see the same thing that one of the most respected people on the street sees. Leon Cooperman knows what's going on. He's giving warnings. I've given warnings. So if you don't believe me, believe him. He's fundamentally based. I'm technically based. We come to the exact same place. And he's talked about the elimination of the uptick rule. He's talked about momentum trading. He's talked about how these algos create excess volatility. And they absolutely do.
Prior sell-offs in the market, you're talking about the uptick rule back to the time of the Depression. Tell people...
One thing that is... The only look, relative to past bottoms I'm aware of, the market's still very expensive. The one place that's extraordinarily cheap is relative to interest rates. It's a no-brainer. I want to get back to what I said before because I think we didn't give enough time. We have to revisit... If you ask me... cutting the rates or reinstating the uptick rule, I'd say reinstate the uptick rule. Rates are already low enough. Rates are not an impediment to companies to invest and do things, okay? The uptick rule was instituted in 1938 in response to the abuses that occurred during the Great Depression. It served us well for 70 years. For some unexplainable reason, they eliminated it in 2007. That gave rise and aided and abetted a lot of these quantitative trading systems, which basically exaggerate moves up and down. Okay, in the last half hour on Friday, the S&P moved like 100 handle points. That's just, it's not related to economics. Now, if and it's as simple as that. So what does the SEC lose by announcing they're going to go to a 30, 60, 90-day trial period to reinstate the uptick rule to see what effect it has on markets, whether it makes markets more orderly? What do they lose? So I don't think we're doing anybody a favor by having these interest rate levels. I think we would be doing the right thing by reinstating the uptick rule.